Hey everybody. Today we will begin an interesting discussion on history. I am ready. Your grandfather retired with a guarantee, not a hope, not a projection, not a fluctuating number on a screen dependent on the decisions of strangers in financial markets he never participated in, a guarantee every month for the rest of his life, a check arrived, the same amount. Predictable, reliable, enough to pay the rent, cover the groceries, maintain a dignity that did not require him to calculate market returns or monitor expense ratios or pray that the economy cooperated with his timeline for dying. He worked. The company promised. The promise was kept. You will not retire this way. You will retire if. The market cooperates with a number on a screen, a number that was higher last year and might be lower next year. A number that reflects the combined decisions of central banks, corporate earnings reports, geopolitical events, and algorithmic trading systems operating at speeds no human can comprehend. A number that is not a promise. It is a probability, and probabilities, as anyone who has watched a retirement account during a financial crisis understands, are not the same thing as guarantees. Somewhere between your grandfather's retirement and yours, a trade was made. The guarantee was taken away. The risk was handed to you, and the system that replaced the guarantee was designed not accidentally, not through the neutral operation of market forces, but deliberately by people who understood exactly what they were doing to ensure that a portion of every dollar you save for retirement flows, permanently and reliably, to institutions that bear none of the risk you carry. Who made that trade? Who benefited? And how was the entire working class convinced to accept it? That is what we are going to find out. Part 1: The Golden Watch Era. WHA took from you. To understand what was lost, you need to understand what existed before. The defined benefit pension was, for most of the 20th century, the foundation of retirement security for working people in the United States and across the developed world. Its mechanics were straightforward. You worked for a company for a defined period. The company, based on your years of service and your final salary, promised to pay you a fixed monthly amount for the rest of your life after you retired. The key word is promised, not invested, not projected. Promised, the company held the investment risk entirely. If the company's pension fund was invested in stocks and the market crashed. In the year you retired, your monthly payment did not change. The company absorbed the loss. The guarantee remained intact. This arrangement made corporations deeply uncomfortable, and for understandable financial reasons. A defined benefit pension is a long-term liability on a corporate balance sheet. The company must project how long its retirees will live, estimate the returns its pension investments will generate, and maintain sufficient assets to cover its obligations across decades. If those projections prove optimistic, if retirees live longer than expected, if investment returns disappoint, if the workforce ages faster than anticipated, the company must make up the shortfall from its own resources. General Motors, at the height of its pension obligations, was described by some analysts as a pension fund that happened to make cars. The pension liabilities were so large, so structurally embedded in the company's financial architecture, that they influenced every major business decision. This was the reality of the defined benefit system. Companies hated it. They had taken on an open-ended commitment to their workforce's retirement security, and that commitment sat on their books as an expanding liability that grew with every year of operation and every additional retiree. But they had made the promise, and for decades, through a combination of labor union pressure, regulatory requirements, and social expectation, they kept it. The pension was not charity. It was compensation, deferred compensation, paid at the end of a working life in exchange for the years of labor that had built the company's profits. The worker had already earned it. The check that arrived each month was not a gift. It was wages paid with a delay. This distinction matters enormously for understanding what happened next. Because when corporations found a way to eliminate their pension obligations, they did not frame it as taking something back from their workers. They framed it as giving their workers something better: more control, more flexibility, more opportunity to participate in the wealth-creating potential of the stock market. It was one of the most successful reframings in the history of modern capitalism. Part to the loophole, the birth of the trap in 1978. The United States Congress passed the Revenue Act of 1978. Buried inside this legislation, in a section numbered 401 in subsection K, was a provision allowing employees to defer a portion of their salary into a tax-advantaged account. The provision was not designed as a retirement system. It was a minor technical clarification intended primarily to address a narrow question about profit-sharing plans for highly compensated executives. Most of the legislators who voted for it did not envision it as the foundation of a new retirement architecture for the American working class, but a benefits consultant named Ted Benner read the provision carefully in 1980, and he saw something that nobody in Congress had explicitly intended to create. He saw a mechanism through which employers could shift the entire burden of retirement savings and the entire risk of retirement investing from the corporation to the employee, legally, with tax advantages that would make the shift attractive to workers, and with a structure that would, over time, allow corporations to walk away from the defined benefit pension system entirely. Benna designed the first 401,000 plan and received IRS approval in 1981. What followed was not a gradual, organic transition. It was a corporate stampede. Companies across America recognized what the 401,000 represented: the opportunity to eliminate one of their largest and most unpredictable financial liabilities. Pension funds could be frozen. New employees could be directed into 401,000 plans instead. The open-ended commitment to pay retirees a guaranteed income for life could be replaced with a defined contribution, a fixed amount deposited into an employee's account each year, after which the corporation's obligation ended entirely. The market went up, the employee benefited. The market crashed, the employee absorbed the loss. The company's obligation was discharged the moment the contribution was made. The risk transfer was total and immediate. Between 1980 and 2000, the percentage of private sector workers covered by defined benefit pension plans fell from approximately 38% to under 20%. By 2022, it had fallen to approximately 15%, and those remaining plans were concentrated almost entirely in government employment and a small number of heavily unionized industries. In a single generation, the retirement security architecture that had supported the American working class for decades was dismantled and replaced with something that looked superficially similar but was structurally its opposite. The old system, company holds the risk, worker receives the guarantee. The new system, worker holds the risk, company makes the contribution and walks away, but the risk transfer was only half of what happened. The other half, the part that would take decades to fully reveal itself, was what happened to the money once it entered the new system. Part 3. The Wall Street Parasite, the Math of Extraction. When your 401,000 contribution leaves your paycheck and enters your retirement account, it does not sit in a vault. It is invested typically in mutual funds, index funds, or target date funds managed by financial institutions that charge fees for their services. These fees are called expense ratios. They are expressed as a percentage of your total assets under management. They are deducted automatically, continuously, invisibly from the value of your account. They do not appear as a line item on your monthly statement. They are not deducted in a single visible transaction that might prompt you to evaluate whether the service is worth the cost. They are extracted silently, daily, as a small reduction in the returns your investments generate, and they compound. This is the mathematics that the retirement industry does not advertise. Not because the math is hidden, it is available to anyone who chooses to calculate it, but because the full picture of what compounding fees extract from a retirement account over a working life is, when presented clearly, genuinely alarming. Consider a worker who saves diligently throughout a 40-year career. They contribute consistently, their employer provides a match, the market performs reasonably well over the period, they accumulate a substantial account balance. By retirement, now introduce the fee. A 1% annual expense ratio sounds trivial. 1 cent on every dollar. Surely negligible relative to the returns the fund generates. Over 40 years, that 1% fee compounds alongside your returns. The fee is calculated on your entire balance, including the returns that have already accumulated. Each year, the fee is larger in absolute terms because your balance is larger. The compounding of fees mirrors, in reverse, the compounding of returns. The result across a 40-year career is that a 1% annual fee reduces your final account balance by approximately 25 to 30% compared to what it would have been in a fee-free equivalent investment, a 2% fee common in actively managed funds and some institutional 401,000 plans reduces your balance by approximately 40 to 45%. Nearly half of your potential retirement wealth gone, not to market losses, not to taxes, to fees charged by institutions for managing money in ways that, in the majority of cases, produce returns that fail to outperform the market average. The financial industry has a response to this criticism. Active management, they argue, can identify opportunities that passive index funds miss. Skilled managers can navigate market volatility in ways that protect investor capital. The fee is the price of expertise. The data does not support this argument. Decades of academic research and industry performance data consistently show that the majority of actively managed funds underperform their benchmark index over any 10-year period. The majority underperform over 20 years. The majority underperform over 30 years. The longer the time horizon in retirement investing involves the longest time horizons of any category of investment, the more decisively passive, low-cost index funds outperform their actively managed, high-fee alternatives. The expertise that justifies the fee measured against the alternative of simply buying the market at minimal cost does not on average exist. Yet the fee is charged regardless every year, in rising markets and falling markets alike. This is the critical asymmetry at the heart of the fee structure. When markets rise, your account grows. The fee grows with it. The financial institution profits. When markets crash, your account shrinks. You absorb the loss. Your retirement timeline is disrupted. Your plans are recalculated. The fee continues, smaller in absolute terms because your balance is smaller, but charged at the same percentage rate, extracted from whatever value remains after the crash. The institution's revenue is reduced. Its losses are not. You carry 100% of the market risk. The financial institution that manages your money carries none. It charges you regardless of outcome, extracts a guaranteed return from your uncertain one, and does so through a fee structure designed to be invisible to the people paying it. This arrangement was not an accident of market evolution. It was the business model that the 401,000 system, as it developed through the 1980s and 1990 seconds, was structured to enable tens of millions of workers, legally required by their retirement circumstances, to invest in the market, channeling their savings through institutional intermediaries who charge fees for access. A captive market, a guaranteed revenue stream extracted from the retirement savings of the working class for decades at compounding rates that transfer hundreds of billions of dollars annually from worker accounts to financial institution revenues. Part for the illusion of ownership. There is a final layer to this architecture, one that operates at a level most retirement savers never think to examine. When you contribute to a 401,000 and that money is invested in a mutual fund or index fund, you become the beneficial owner of shares in that fund. The fund in turn owns shares in the companies that comprise its portfolio. You are, in a technical sense, a part owner of Apple, Microsoft, ExxonMobil, JP Morgan Chase, and hundreds of other corporations whose shares your fund holds. But ownership, in a meaningful sense, involves more than holding a claim on a portion of a company's value. It involves the ability to influence how that company is governed. Shareholders have voting rights. Those votes determine who sits on corporate boards, what executive compensation looks like, whether the company pursues certain strategies or avoids others. In a dispersed ownership system where millions of individual shareholders each hold small stakes, these votes are meaningful in aggregate. If shareholders are dissatisfied with corporate governance, they can organize, vote, and change the direction of the company. But you do not vote your 401,000 shares. The fund manager votes them. BlackRock, Vanguard, State Street, Fidelity. The giant asset management firms that operate the funds inside which most retirement savings are held cast the votes attached to the shares their funds own. They vote on behalf of their fund investors, which means effectively on behalf of the retirement savings of tens of millions of American workers. The three largest asset managers, BlackRock, Vanguard, and State Street, are collectively the largest shareholders of the majority of companies in the S&P 500. Through the retirement savings of ordinary workers, these three institutions have accumulated voting power over the corporate governance of virtually every major American corporation. This voting power is exercised by the asset managers, not by the workers whose savings created it. The worker whose 401,000 holds shares in a major corporation has no direct voice in how that corporation is governed. The asset manager, holding billions of shares across hundreds of millions of accounts, speaks for all of them. The implications are significant. Asset managers, as institutional shareholders, have interests that are not necessarily identical to the interests of the workers whose money they manage, their relationships with corporate management, their business interests in maintaining access to corporate retirement plan mandates, their institutional perspectives on executive compensation and corporate strategy. All of these shape how they exercise the enormous voting power that worker retirement savings have placed in their hands. The worker contributes to a retirement system to secure their own financial future. In doing so, they provide the capital that gives giant asset management firms governance influence over the entire corporate landscape. The worker bears the investment risk. The asset manager exercises the power. You finance the purchase of the shares. Someone else decides what to do with them. This is the final irony of the modern retirement system. Workers whose pension rights were eliminated in the name of giving them more control and ownership of their retirement destiny have ended up with less control over both their retirement security and the corporate governance of the companies their savings support than their grandparents had under the old defined benefit system. The grandfather with the pension had a guarantee. He also had a union that negotiated that guarantee, a corporate counterparty legally bound to honor it, and a regulatory framework that enforced compliance. The grandchild with the 401,000 has a fluctuating account balance, an expense ratio they probably cannot recite from memory, voting rights they cannot exercise, and market risk they cannot hedge. They were told this was an upgrade. The climax, the system working as designed. Stand back from the individual components and look at the complete architecture. Corporations eliminated guaranteed pension obligations and replaced them with defined contributions, transferring 100% of retirement investment risk to their employees while capping their own liability at the contribution amount to the money. Workers contribute to their retirement accounts flows into funds managed by financial institutions that charge fees regardless of performance, compounding those fees across decades in ways that extract a substantial portion of potential retirement wealth silently and automatically. The voting rights attached to the shares purchased with. Worker savings are exercised by the asset managers who hold those shares, concentrating governance power over the corporate landscape in a small number of institutional hands. The worker at the center of this system bears all the risk, pays all the fees, and exercises none of the power, and the system was designed this way, not through conspiracy. No secret meeting determined these outcomes, but through the rational pursuit of financial self-interest by institutions with the legal sophistication and political influence to shape the regulatory environment to their advantage. Section 401,000 was a minor tax provision. Corporate benefits departments weaponized it to eliminate pension liabilities. The financial industry built a fee extraction infrastructure around the resulting captive market. Asset managers accumulated governance power as a byproduct of managing the resulting assets. Each step followed logically from the previous one. Each participant pursued their interest within the legal framework available to them. The cumulative outcome, the replacement of a guaranteed retirement system with a fee-laden, risk-transferred, governance-concentrated alternative, was not the stated goal of any single actor. It was the emergent result of a system optimized for institutional profit. Rather than worker security, we are financing the institutions that profit from our labor. We are taking on the market risk that corporations once held. We are providing the capital that gives asset managers governance power over the corporate world. And we are paying fees for the privilege of doing all of this that compound over decades into one of the largest transfers of potential wealth from workers to financial institutions in the history of capitalism. We were told this was financial empowerment. We were told that managing our own retirement gave us freedom and ownership and participation in the wealth-creating machinery of the market. What we received was the risk without the guarantee, the fees without the returns, and the appearance of ownership without the substance of control. The golden watch is gone. The pension check that arrived every month like a reliable tide gone. In their place, a number on a screen, a probability rather than a promise, a retirement that depends on market conditions, fee structures, and the decisions of institutions whose interests are not identical to ours. Your grandfather did not need to understand expense ratios. He did not need to monitor his asset allocation. He did not need to pray that the market cooperated with his retirement date. He worked, the company promised, the promise was kept. You will work. You will contribute. You will monitor and adjust and hope, and somewhere in the gap between the promise that was kept and the probability that replaced it, an enormous quantity of wealth has moved from the retirement security of the working class to the guaranteed revenue streams of the financial institutions that manage their money. The system is not broken. It is working exactly as the people who designed it intended. The defined benefit pension was eliminated not because it failed workers. It was eliminated because it succeeded, and that success was a liability on a corporate balance sheet. The 401,000 replaced it not because it was better for workers. It was better for corporations and for the financial industry that grew up around it. The math of compounding fees, the invisibility of expense ratios, the transfer of voting rights to asset managers, none of this was explained to the workers who were told they were receiving an upgrade. Now you have seen the math. Now you understand the architecture. The retirement system was redesigned around the interests of the institutions that benefit from it. The workers who fund it were the last consideration in that redesign, if they were considered at all. That is the retirement mirage, a system that looks like wealth building and functions like wealth extraction, a promise of security built on a foundation of transferred risk, compounding fees, and concentrated institutional power. Your grandfather's golden watch was real. What replaced it was a carefully constructed illusion. If this gave you a new perspective, subscribe to Economic Chronicles, the hidden architecture of money and power. We show you where to look.